What if I told you that some of the world's biggest companies are secretly selling at a discount, while millions of investors are completely ignoring them?
Just imagine buying a $100 bill for only $70. Sounds impossible, right? I mean, who would just hand you $30 for free? Well, in the normal, everyday world, nobody would. But in the stock market, that impossible-sounding discount is exactly what value investors spend their lives searching for.
Today, we're going to reveal how professional investors, hedge funds, and even artificial intelligence identify undervalued stocks before the rest of the market catches on. We'll talk about why so many trend-chasing investors completely fail, usually because they buy at the very peak of the hype, purely out of FOMO, only to watch it all crash. And by the end of this video, you'll know exactly how to spot these hidden opportunities yourself.
Okay, let's dive into this. Here is our roadmap for today. 1. Decoding the mispriced market. 2. Financial metrics and AI. 3. Top value stock picks. 4. High growth and tech opportunities. 5. Risks and value traps. And 6. The Smart Investor's Playbook.
Section 1. Decoding the mispriced market. Understanding the gap between price and value.
So what exactly is an undervalued stock? Well, simply put, it's a company whose shares are trading for way less than they're actually worth. But to really get this, we got to understand the massive difference between price and value. And that brings us to a huge concept, intrinsic value. This is the fundamental true worth of a stock. It's built on hard, undeniable facts. We're talking the company's assets, its earnings, the dividends it pays out, and its actual cash flow. It has absolutely nothing to do with market sentiment or whatever meme stock is trending today. It's just the objective reality of what that underlying business is worth. Finding companies trading below this intrinsic value, that's literally the holy grail of investing. Like our source from IG International says, buying undervalued stocks is the keystone of all value investing strategies, including Warren Buffett's investing philosophy. When you pull this off, you're essentially buying $1 for 70 cents. You're getting a slice of a highly profitable machine for a fraction of what it would cost to build from the ground up.
Let's compare intrinsic value directly with market price so this really clicks. Market price is just what someone is willing to pay for the stock at this exact fleeting second. It's completely driven by human emotion. Think of it like this. If intrinsic value is the deep, concrete foundation of a house, market price is the daily weather report. Some days, it's sunny, everyone's feeling incredibly optimistic, and people drastically overpay for the house. But then, a storm rolls in. People panic, the market price drops way below the intrinsic value. That disconnection, when the storm is raging but the concrete foundation hasn't moved an inch, is where the smart investor makes their move.
But why does this happen? Why do markets make these huge pricing errors? Honestly, it almost always comes down to market fear and human overreaction. Just imagine a rock-solid tech company missing their quarterly expectation by literally 1 penny. The next morning, terrified investors might dump the stock, causing a 15% crash in a single day. The actual intrinsic value of the business didn't drop 15%, but the market totally overreacted. Economic downturns, scary stories in the media, a specific sector crashing, or maybe just a really temporary supply chain hiccup. The market hyper-focuses on the short-term bad news, tanking the price, while the long-term value stays totally intact.
Section 2. Financial metrics and AI. The Modern Value Investor's Toolkit. Okay, so how do we actually find these discounts in the wild? If you're a beginner, listen, you don't need a math degree, but you do need to grasp a few key metrics. First up is the price-to-earnings, or PE ratio. Just think of this as how much you're paying for a single dollar of the company's profit. If a company has a PE of 10, you are literally paying $10 to get $1 of earnings. A lower PE often screams, hey, this stock might be cheap. Next is cash flow. You can creatively hide a lot of things on an accounting sheet, but you cannot fake cold, hard cash. Cash flow proves the company can actually pay its bills and survive the rough times. Then there's the discount, the gap between the current price and intrinsic value. This feeds right into your margin of safety. If a stock is fundamentally worth $100 and you snag it for $70, that $30 cushion is your margin of safety. If the economy completely tanks, that buffer protects you. And finally, growth potential. Because hey, we don't just want a cheap business, we want one that's going to grow. Now, crunching these numbers for thousands of stocks used to take professional analysts weeks of grueling spreadsheet work. Today, AI does the heavy lifting in seconds. Using a tool like the Investing Pro AI Hybrid Screener is a total game changer. You just set your filters, maybe looking specifically for major US stocks, and the AI chews through mountains of historical data. It spits out health scores, flagging companies as good, great, or excellent based on bulletproof financials and crazy good cash flow. If you're finding this video helpful and want more investing guides like this, take a second to hit the like button and subscribe to the channel.
It really helps us create more educational content for you.
Section 3. Top Value Stock Picks. High Upside Opportunities from Investing Pro. Now, what's really interesting about this slide is the sheer quality of the companies the AI found. Let's look at the actual output of this AI screener. These are top value stock picks from the S&P 500. They all have market caps over $15 billion, incredibly solid PE ratios between 1 and 20, and huge fair value upside. We're talking about massive, dominant companies here. In software, you have Adobe, the undisputed king of creative tools, Intuit, which literally runs the world's accounting, and cloud giant Salesforce. In healthcare, there's the Cigna Group, an absolute powerhouse, and Zoetis, the biggest name in animal health. We've got global facilitators like PayPal and Trip.com, and rounding it out, infrastructure and resource titans like Comcast, IT consulting massive hitter Accenture, and Newmont, one of the top gold and copper miners on Earth. These aren't risky startups. They are highly attractive because of their deep competitive moats, incredible business quality, and phenomenal long-term outlooks that the broader market is just totally sleeping on right now.
To put the power of this into perspective, just look at this number, 70.5%. According to the Investing Pro models, that was the fair value upside for Accenture at the time of the report. The AI crunched their massive earnings, undeniable free cash flow, and sector dominance, and basically said the market was getting it entirely wrong. For the stock price to simply catch up to what the business is actually worth, it would need to climb by over 70%. No way, right? But that is the literal power of filtering out the daily market noise.
Section 4. High Growth and Tech Opportunities. Let's move to and see how this builds into tech-focused value picks from IG International.
This list comes from the top holdings of the iShares MSCI World Value Factor ETF, and it gives us an amazing look at blue-chip tech and telecom companies priced way below their true value. Look at the companies building our future networks. AT&T and Verizon are sitting at wildly low PE multiples of 18 and 17, even as they roll out global 5G. Then there's foundational tech. Cisco, a networking giant, trades at a PE of 26. IBM, a massive AI and cloud consultant now, is at just 33. Qualcomm basically owns the patents for 5G globally and sits at a PE of 19, while Intel pushes hard into quantum computing. Outside of pure tech, we see Toyota, a hybrid pioneer, at a ridiculously low PE of 9. Global banking titan HSBC is trading at just 8. Comcast shows up again here, and we even see British American Tobacco, which is paying huge dividends to investors while heavily pivoting toward non-combustible products.
Section 5. Risks and Value Traps. When a bargain is actually a trap. And if you haven't subscribed yet, now is the perfect time. We publish simple, research-based investing videos every week. Like this video and subscribe so you never miss an opportunity to learn. Now, we really need to talk about risk management.
Value investing is incredibly rewarding, but you have to know the difference between an undervalued stock and a total value trap. An undervalued stock, like we've said, is a great company facing temporary headwinds. It's going to bounce back once the market wakes up. But a value trap? That's a dangerous mirage. It looks cheap on paper. Maybe it has a massive dividend or a super low PE, but it's cheap for a very good reason. The underlying business is completely broken. Maybe their core product is obsolete, management is a disaster, or they're drowning in debt. The price is never going to recover, and if you buy it, you're stuck.
Dodging these traps requires real research because the risks are real. You have to stomach serious market volatility. Sometimes a cheap stock gets a lot cheaper before it goes up. Trying to perfectly time the exact bottom of a crash is called catching a falling knife, and trust me, it's a great way to bleed out your portfolio. You've got to be immensely patient. You need a long-term horizon because there's absolutely no timeline for when the market will finally recognize a stock's true value. Could be months, could be years. And because of that, diversification is absolutely essential. Do not put your life savings into one undervalued stock. Spread it out. If you buy 10 value stocks and one turns out to be a trap that goes to zero, the massive gains from the other 9 will completely protect your overall portfolio.
Section 6. The Smart Investor's Playbook. Key takeaways for your portfolio.
We've covered a ton of ground today. Let's lock in the absolute biggest takeaways. First, markets make mistakes. Human panic creates highly lucrative discounts on amazing companies. Second, patience wins. We are buying robust businesses for their long-term cash flow, not trying to day trade a meme stock. Third, research matters. You have to know the difference between a temporary bump in the road and a permanent value trap. And finally, AI is an incredible tool to cut through the noise, but it is not a replacement for your own critical thinking. Remember, the best investments are often found where everyone else stops looking. Thank you so much for watching. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications so you never miss our next investing guide. Thanks again for watching, and I'll see you in the next video.